Welcome back, everybody, to our weekly news update. All right, every week, Tuesdays at this time, we have kind of culled through all of the things that are going on out in the marketplace. Right, lender updates, FICO updates. Well, we just happen to be going through some of our resources, and Sky is our producer as well as our major research source of finding the best articles, the best intel to deliver to you guys. All right. So, interestingly enough, one of the things that happened about a month plus ago, but it has really impacted the news this past week, is PPP loan fraud, right? So this is a hot topic because there was literally, it was like a gold rush, right? When they flipped on those those levers to say, hey, file for these emergency assistance loans, these paycheck protection loans, all of a sudden the gates were on. Now, interestingly enough, the media has helped open up these coffers to see how big of a problem there's been. So I got a bunch of quotes for you. Got some great intel about what has been happening with loan fraud. Now, PPP loans were designed to protect, be able to pay for your rent as a business, pay for your pay for utilities, and keep paying at least 6 weeks worth of payroll, right? Now, it was also defined broadly enough that if you're a dog walker, if you're a 1099er, if you're a designer, this was supposed to be very inclusive, but I don't think it was meant to be this inclusive. So let's take a look right now. Business Insider just did an article this last week called "Congress Opens Investigation into Blue Vine and Cabbage After Reports of PPP Fraud." Now, let's kind of separate out, for those of you who've been to my boot camp, those of you who've read the book, there are varying degrees. There are 4 different tiers of lenders, right? Well, the lenders we're talking about now, Blue Vine, Cabbage, etc., those are tier 4 lenders. They're fintech companies, they're finance companies, and they actually lend from a pool of investor money, right? Then supposedly there's these investors are supposed to get paid back from federal coffers at SBA, the Small Business Administration. Well, there were others, some tier 3 banks and tier 2 banks, Celtic Bank and Cross River Bank, who were partners with fintechs who underwrite some of the fintech dollars. They're also being investigated. So let's get into the crux of this. There, from this article here, there was a quote that said 75% of PPP loans connected to fraud were associated or processed by fintech companies. Now, these only represent 15% of all PPP loans, but of this 15%, 75% look fraudulent in their first flush and the first investigation. Think about that. Thankfully, there are only 15% of all PPP loans were processed here, but 75% of those 15%, 75% of all fraudulent loans were done by these, were processed by these fintech companies. 75% of all fraud. Now, let's kind of back out a little bit, because an investigation by ProPublica found that Cabbage facilitated 378 loans totaling over $7 million to businesses that don't even exist. Now, single person businesses that don't appear in corporation records of their respective states. So that means that the Secretary of State doesn't even have a record of a business that was filed for the PPP loan. And the overwhelming majority identified themselves as farms, typically registered to residential addresses with no discernible agricultural activity. Some of these were even like potato fields in Florida and orange groves in Minnesota. Now, even if they have done just a first flush, just a first flush review, a bare minimum due diligence would have been conducted on these applications, and they would have seen that potatoes are not a staple crop in Florida, and neither are orange groves a staple crop in Minnesota. So these grossly fraudulent applications appear in every way to have gotten under the radar through the fintech companies. Now, what was interesting is that the tier 1 and tier 2 banks, JP Morgan Chase, Wells Fargo, a number of the larger banks were working with their current client base to do PPP loans. For instance, we had a number of clients our clients themselves were telling us, hey, I'm getting emails from Wells Fargo, from Chase, from Citi, that we should do our PPP with them. And we're like, you've already established a relationship with them, so go for it, right? Well, if there's already a relationship, think of it. Think of why we talk. I preach the gospel of relationship building with the lenders for a reason. All of the banks that you have a relationship with have already tested out the viability of your business. They've given you, or you've given them, what the SIC or the NAICS code is all about. They know, they may have already done due diligence on the who is your client, right? Third parties who actually investigate the nature of your business. They have vetted you in a number of different ways, and you've already passed muster with banks that you have an established relationship. Well, all of these fraudulent loans, nobody had a relationship with a fintech company. They're not depository institutions. They don't issue credit cards. They don't issue credit lines or loans, other than these specific personal and business these personal business credit instruments. No relationship building was required, and so automatic underwriting guidelines just sailed past and accepted many of these applications, fraudulent applications. Now, what's interesting is not only do the larger banks have their due diligence on you as a borrower, especially as a business, their due diligence includes a top-down review of all of your data points, right? Your DNB files, your Experian Business, your Equifax Business credit reports. And if you're part of my team, if you're part of my crew, I've showed you how to actually build bulletproof personal and business identities that are then validatable, if that's a word, that can be validated by your lenders. Well, none of this was happening since they're fraudulent. No relationship building activities were used at all, and that's why these and automatic underwriting just said legit, and fintechs charge higher interest but have looser underwriting guidelines than the top tier 1 and tier 2 banks. Since it's looser, they're willing to take the risk by charging more interest, but since they're government-backed loans, the validation points were not as significant, and fraudulent loans were able to get under the wire. All right, now, especially folks who don't have a good relationship with their current banks, or they've had insufficient funds and overdraft fees, etc. They might have gone to the fintechs simply because they didn't have a good relationship with their current institutions, right? Fintechs also boasted that their automatic application processes had very little human intervention. Now, normally in automatic underwriting, if the underwriting criteria is solid, then we want very little human interaction, right? Fintechs actually do have underwriting departments, and they have underwriters, human beings that are underwriters. One of our advisors on our advisor team formerly worked at a fintech underwriting group, right? The problem is that these underwriters, they literally push through and here's the problem, because they're government-backed loans, it's easy to push through any of these applications without a great deal of due diligence. Now, another quote, 98% of Cabbage's PPP borrowers were new clients. And Cabbage says that due to its commitment to data and technology to drive innovation, more than 75% of its approved loans were approved without human intervention. So they're committed to approving through automatic underwriting, through data and technology-driven approvals. But in this case, those underwriting guidelines that are coded into their software were insufficient to capture these particular problem loans and problem applications. Congress, of course, now is not okay with that. They want to know whether these fully automated processes make fintechs the choice for fraud rings, right? Are fintechs more susceptible to fraud because of this automatic underwriting? But as an industry insider, I am going to separate the fintech automatic underwriting from we prefer tier 1 and tier 2 banks. More consistent underwriting. Even the automatic underwriting does a ton of data matching. I guarantee you data matching was not done in these particular loan applications, and the fintechs were just rolling them through a less careful, less detail-oriented underwriting criteria. Now, multiple instances of fraud could have been prevented had the fintech simply conducted web searches for the company name or the inactive, non-existent, or otherwise clearly ineligible applicants. That's the final quote from this article. I mean, if they would have just done a web search for this farm or this business, because businesses are registered as farms, even family farms are registered as businesses in order to get the various relationships with government and agencies, et cetera. It's required. So in our system, we not only set up our clients and our students, teach them how to establish the data checking points of automatic underwriting, but we also want you to be able to pass what we call a 30-minute underwriting, right? A 30-minute check where we evaluate your website for the right language and the right messaging to inspire approvals, right? Truth, the whole truth, and nothing but the truth. And we want to make sure that you have access to so that underwriters are looking for certain key points to be displayed in your websites. We want to make sure we hit that. We also want to know if you dial 411 and ask for your business, do the directories know who you are and where that is and how to find you? There are a number of real world, if we want to call it that, real world things that takes an underwriter mere moments to check to see if you're legit. Our clients get the approvals because they pass all of these. We have them prepared to pass all of these underwriting guidelines, including any manual checks, right? That was not the case in these for these PPP loans, because they didn't even search a company name in Google to see if something was legit. And again, they said 98% of the borrowers were new clients and 75% of the loan applications were processed without human intervention. How much time? But part of the problem is that since they're government backed, the government has the obligation to carry this paper in the long term, not Cabbage or these fintechs. And so they care a little bit less. So where we stand here, we're going to drop these articles into the comments so that you guys can weigh in on them, check them out. But that is our update for today. I absolutely love. We've got a couple of people here. There they go. There's your Business Insider links, and And we've got a couple of comments saying potatoes don't grow in Florida and oranges don't grow in Minneapolis. Yes, that is correct. So thank you guys for weighing in. Glad to have you join us today. Derek, great to see you. And remember, you heard it here first. The truth you can trust. We're going to make sure that we suss out what's happening in the lender world, what's happening in FICO world, and make sure that you have up-to-date intel on what's happening for your funding approvals. Give us a like, give us thumbs up, send us hearts, follow, share this to other folks who you know have done PPP loans. Just spread the love, you guys. Let everybody know. We want everybody to be informed, stay informed, and stay with us. We'll see you next Tuesday at this same time for the next news update. This is Merrill Chandler, your host of the Get Fundable Universe. And let's get fundable together, guys.